So, good day once again. In today's section, we are going to look at the discounted cash flow technique. But before that, let's look at this particular question carefully. Great. So let's look at this set of questions. The very first question is the Land of Grace and Blessing Limited. Land of Grace. This particular question is the very first question of your examiner, April 2017 question. That's question 4. So, and it's still trial. I still have one question pending. So, I'm adding this one to it. First, calculate the following and interpret your answer. Payback period. Then, accounting rate of return based on average investment. Like I said, a good examiner will tell you which method you should use because accounting rate of return, there are two methods. Either the average investment approach or the initial investment. So take notes of that. So we need a solution to this very one and this very one. Today we'll look at the NPV then to end the game. So that's a trial work. That's question 4, April 2017. Great. Now let's continue the game. There's a B part. Why are accounting rate of return and payback method of investment appraisal popular in practice in spite of their theoretical inferiority to the discounted cash flow techniques? They are just asking for importance of payback period and accounting rate of return. Good. So if you can give us 3, we are fine. So I'm adding the B to it. Kindly look at it for me. And for those who do that, they will smile because this is coming from directly your examiner. So, and the next question that we look out for is Abrifa Limited. Abrifa Limited is October 2017. That is October 2017. Abrifa Limited. October 2017 is the Abrifa of 2018. October 2017 Abrifa. No, that's not October 20. So immediately after that particular question, the very next one is this. In fact, I've arranged them in order. Immediately after this particular question, the one that we've looked at it, this very one, the next question that the examiner said was on this, Abrifa Limited. And this is in the handout, our main handout. It's in there. Great. And that question was updated and repeated in October 2019. Great. So updated and repeated. Great. So some of these questions, you can see them in the handout. So I will open it to you where you can see them and then how the arrangement goes. In your handout, there's a section called questions without solution. So take notes. That's the tutorial questions. They are the section that I piled the exams question there. So like Abrifa is very here. Oh, so this is Abrifa, October 2017, question number 2. So October 2017, question 2. Yeah. So that's Abrifa Limited. Good. Okay, now let's continue the game from the other section, from the investment appraisal section. Okay, so from Abrifa, okay. So from Abrifa Limited, we move on to the next one. The next one is Madam Zavi. This is October 2019. The April 2019 is in the other handouts. That completes all questions. So if you look at this particular question, it's just the remix of the Abrifa. Take a critical look at Abrifa question. How they note the question was structured. 15,000 units at 200, 175. If you check Madam Zavi, the same thing, but here is 200,000, 200, variable cost 175 in that order. Great. The question that came in April 2019 to complete all your questions is also here. That is the two projects. They are also in the handouts. So let's go to that one too, so that you know all questions that has dropped so far under the investment appraiser. So when you are solving them, if you're able to go through all this, it should be fine on your own. So there's a question here called Agape Ventures. Yes, Agape. This particular question. Yes, intervention October 2019. Okay, there's a one. Okay, I call my own Agape. Then his own was somewhere here. Yes. Good. His own is the new ventures. That's April 2019. So far, these are all investment appraisal questions dropped from 2017 April to date. So all of them are here. Good. Here too, still assess the two projects using payback period, as usual, and then the NPV method. So that is it. Great. So on that note, we will continue the game and then finish it up. But please and please, kindly try all the assignments for me, the trial works. Good. Now the next set is the discounted cash flow techniques. So we call it discounted cash flow technique. That's the third section. Discounted cash flow methods. Under this method, we have three. We have what we call adjusted or discounted payback period. Then we have NPV, net present value. Then we have internal rate of return. So these are the sections that we have to go through them, and then we are fine. Good. So basically, so let's quickly go through them today. We might be able to finish this too. Then this one, we use the video to go through. So adjusted payback period. Now, this discounted cash flow together, they have some three good news about them. The very first one is that they take into consideration time value of money. So they take into consideration time value of what? Money. Meaning they consider the fact that one Ghana cedi today will not be the same as one cedi tomorrow or in a year's time. So all the cash flow needs to be discounted into today's terms. Good. That's it. And then two, all of them use cash flow. Wow. Cash flow. That's perfect. All of them use cash flow, but not profit. It's a good news because cash flows are not highly manipulated by subjective accounting policy. That is it. Then number 3, all of them incorporate risks. So risks. So if you're looking for the appraisal techniques that incorporate these 3 items, they are the cash flow techniques. So the discounted cash flow techniques. And these important, you will see them that it runs through all of them. So if we pick adjusted or discounted payback rate, this one will be part of the important. If big NPV, this will be part of the important, and then you add that. So let's quickly go through the adjusted payback period. The word adjusted or discounted simple means the cash flows must be discounted. You have to discount the cash flow. The issue is this. Let's give ourselves this illustration. So we started with discounted cash flow techniques. Discounted cash flow techniques. So discounted payback period. That's where we are now. Payback period. So let's assume that we have to invest the following amount. So a project, so let's say project A have the following cash flow. So year, let's assume that year 0. You have to invest, let's say, 50,000 Ghana cedis. That's the investment. Year 1, these are cash flows. Don't forget that payback means cash flows, but not profit. If they give you profit, can you convert it to cash flow? Thank you. So number 1, maybe they have 20,000 here. Number 2, they had 5,000 negative. Number 3, or year 3, they started growing cash. They have 30,000 for this. Number 4, they have 25,000 for this. That year 4, 25,000 for this. Then year 6, they have 10,000. No, year 5, sorry. Year 5. Then they had, let's say, just 10,000. Yeah. They had 10,000 for this. If the company's cost of capital, if the company cost of capital is 10%, what is the adjusted payback period? So we assume that the company's cost of capital, so I'm continuing the question. Note 1, cost of capital, is 10%. That's all. So with that discounted payback rate, first, discount the cash flows first. What's the meaning of discounting? Discounting simple means this cash flows or this money that they say they will earn is in future terms. So let's bring in today's terms. So they are here telling us that exactly 1 year they will get 20,000. And you know that 20,000 at the end of year 1 or in a year's time, that is 12 months time, it's not the same as 20,000 today. So let's find the actual value. Let's discount it. Yes. If someone has promised you that will give you, let's say, 40,000 in 5 years' time, if the person should have given you that 40,000 today, you could have invested the money or use the money for profitable business, which will give you more than 40,000 that the guy is promising you in what? The 5 years' time. So that is the discounting. So in short, we just have to find the present value by discounting the cash flow. How do you discount the cash flow? Multiply the cash flow by the discount factor. So discount factor is 10%. So you write it here. So this is the question. If you copy them again, you come here, tell the examiner discount factor into bracket 10%. Then from there, you go to the present value of the cash flows. Here's the PV of what? The cash flows. Then you are done. Perfect. How do you find the discount factor? Discount factor simple means the rate at which the money will change value. So we have a formula. So it's equal to 1/1 plus R. R is the cost of capital to the power n. So if you're in year one, just 1 plus the discount factor is the R, the cost of capital given to you, usually in percentages. So what you do is you be 1 plus 0.1 like this. If in year one, put 1 as the raised power or the exponent. If in year 2, put 2. Then year 3, put 3 in that order. Whatever answer that you get, you keep in to 3 decimal places. Then you are done. Good. So that is it. But for those of you who are using the macula type, the macula calculator, yes, there should be a smart way to get the discount factor easily. So we will try that on all the alternatives to get it done. So first, all what you have to do is this. You put 1 here. So the answer will be 1 divided by 1.1. Perfect. That's for the year 1. Now, for year 0, always don't even worry yourself to calculate. To give you what? 1. Because 1 Ghana cedi today is the same as 1 Ghana cedi. So it will not change value. If I have 1 Ghana cedi today, it will not change value. It is still 1 Ghana cedi. It will only change if time also change. So that is it. Or if you like, you put 0 here, raise to the power 0. The answer will still be 1. Because any number raised to the power 0 is what? It's 1, right? Good. So you put 1 here. Then what do you do again? 1 divided by 1, the answer is 1. So don't need to worry. Let's go to year 1. So you point this on your calculator. 1 divided by 1.1. What will be the answer? 1 divided by 1.1. Get the 0.909. Please run it to 3 decimal places. Can you run it to 3 decimal places? Good. So with the discount factor, they'll give you cost of capital in the question. 10%, 20%, 40%, then you are done. Now, if it is 10%, you're looking for maybe year 1, just bring it here like this. Bracket 1 plus that discount factor, convert it to what? Into decimals. Get the 1, and then if I'm year 1, put 1 there, year 2, put 2 there. Thank you. But for those of you who are using macula, now be with me. Let's calculate together. For your first year, because there's no exponent there, for those of you who are using macula, because there's no exponent, just do like this. For the year 1, 1 divided by 1.1. Why 1.1? 1.1 because it is 1 plus 0.1. And that will give us 1.1. That is it. What is the answer given to us? If you do it well, the answer should be 0.909. That is perfect. Kindly run it to 3 decimal places. Put the answer in. Okay. Then go to year 2. When you go to year 2, discount factor for year 2, just type the answer. So for those of you who are using the answer, so type this one, the answer that you see on the calculator. So answer divided by 1.1 like this. You punch it on your calculator. It will give you an answer. The answer will be 0.826. Agreed. So confirm. You get the same. Perfect. So year 2 will be 0.826. Then when you go to year 3, so this answer, no, the answer that you have in here, this particular answer, again, this particular answer divided by 1.1. So just be dividing your answer by 1.1. And this one will give us 0.751. Agreed. 0.751. Agreed. 0.751. So you'll be 0.751. Great. So this is for the calculators that do not have the exponent function. You cannot type exponent, raised to the power 2, 3, or 4. Then you move on. You go to year 4. So in year 4, you pick this answer and then you divide it by 1.1 to give you this answer. Then you write it here nicely. That will give us 0.683. Agreed. Finally, you pick this one again, divide by 1.1, it will give you 0.621. Perfect. Then you are done. So this is how you get the discount factor from calculators that don't have the exponent function. Okay. Now I'll look for 2 different calculators. This one is Macaulay type of the calculator. Now let's go to the scientific, those who have the scientific, or let's say the FX or the MX. So I'm going to do the FX like the MX. Those calculators, how do you get this straightforward? Those calculators have the exponent function. So calculators that have the exponent function, straightforward, 1.1 for the first year, 1/1.1 like this to the power for the second year, year 3, 1.1 to the power 3. Because those calculators have exponent function. So you punch, you get the same answer. Great. That one too, there must be a smart way. So let's see the smart way. Now be with me. What I'm come to do is it's highly sleepy. So, but if you get into it, you'll be fine. It's so interesting. So be with me. These discount factors issues, do not worry us. It's not part of the examination. So to get a discount factor for year 1, this one, whether Macaulay or scientific, it will work. But it worked well for the scientific, the FX or the MX. First, punch 1 divided by 1.1. That's the first year. You have 0.909. When you go to year 2, when you put the answer, don't distort your calculator. Those who are using the FX and then the MX, don't distort your calculator. Don't distort it. Don't press anywhere again. Write this answer in your book. Come back again. When you go to year 2, just punch on the answer key. The answer key like this. Ants. Punch on the ants. Divide it by 1.1. And then press the equal to sign. You get something like this. 0.826. Right. Don't worry. The answer will come. Write it in. Still, please don't distort your calculator. Don't distort the calculator. Now, just press the equal to sign again. Tap on the equal to sign again to give you the number 3 answer. Without typing all this. So you just type the equal to sign. It will give you the answer, 0.751. Again, tap the equal to sign again to give you the year 4. Type the equal to sign again. Year 4. So that's 0.683. Again, type the equal to sign again. It will give you the year 5 on 0.621. Here, the danger is that if your hand maybe it's fast and you tap it 1, 2, it will jump and give you the next one. So that is okay. Don't forget, what if the cost of capital is 20%? Let's do that one too. If it's 20%, then it will be 1 plus 0.2. So that will be 1.2. So here will be 1.2. Then you write the first answer down. Write the first answer down. Then you come again. The answer that you had divided by 1.2 in that order. Then you are done. So that's how the cost of capital we get them. But sometimes if you are lucky, or if it happens that the examiner said the question on his birthday, they'll give you, or he will give you the cost of capital already in the question. Like the very first question that I projected, the cost of the capital was given. But subsequently, no, he didn't give the cost of capital. That's perfect. So now we're able to derive the discount factors. Let's go straight and then move from there and then come to the main question. Good. Finally, what if it's 15%? In fact, let me where's the case. What if it's 15.52%? How do you get the discount factor? If it's 15.52%. Okay, so how do you get it? First of all, tell the examiner that 1 plus 0.1552. Convert it to what? To decimal. Then year 1 will be 1 divided by, this answer will probably give us 1.1552. So 1 divided by 1.1552. You put the answer down. Whatever answer you get, when you go to year 2, that answer will be divided by what? 1.552. You get another answer, hit that one. When you go to year 3, divide it by what? 1.552. That is for Macaulay calculators. Perfect. Good. So that is it. That is for Macaulay calculators. Those that do not have the exponents. If your calculator is the FX or the MX, which have the exponents, oh, then you don't need to worry. For that one, you go by this. You tell the examiner 1 over 1.1552 to the power 1 if in year 1, to the power 2 if in year 2, to the power 3 if in year 3, and to the power 4 if in year 4. In that order. We are done. There are so many versions. You also have 1.155 minus 1 if in year 1. Yes, minus 2 if in year 2. Minus 3 if in year 3 in that order. It's also acceptable. Okay, so we are done. Please, I took my time on a discount factor because we need it in all the discounted cash flow techniques. All the 3 methods I wrote there, you need discount factors. So if you get it here, it will help us in the subsequent ones. Thank you. Now let's get a PV, present value. Just relax. You multiply the cash flow by the discount factor. So multiply. But we shouldn't put multiplication, no, they are invisible. Obviously, we shouldn't do that too. Yes, it will make our work too clumsy. So you leave it. It's invisible. They are not implied. So 50 by 1 to give us 50,000. That is. Then 20,000 by up in there. Great. So we'll have 180, 180. Yes. Then year 2, you have 4130. So 4130. But it's negative, so put it in brackets. Year 3 is 22,530. 22,530. Year 4 will be 17,075. So 17 and 75,000. Year 6. Wow. Okay. So, but year 5 happened to be 6,210. Okay, so year 1 is 18,180. Okay, it's 18,180. Thank you. Then here will be 6,210, right? That's year 5, 6,210. Perfect. We are done. So this is the present value. Then you move. As usual, payback, we need to get a cash flow. So now this one becomes the present value of the cash flow. So this is what we are going to use to assess the payback period. So first, write your balance. So let's go as usual. They have 50,000 to clear. So the balance at the end or at the start of the year 1, which is year 0, will be 50,000 negative. Then at the end of year 1, they had 18,180. So to clear from this 50,000 that is invested. So what will be the balance? So the balance will be at the end of the year 1, 31,820. So 31,820 negative. But at the end of year 2, they had a loss. Negative cash flow, meaning cash outflow. So to increase this amount, the one did not come. The one did not come. So now it's in. So 31,820. So now it will increase the outflow that we have. So we have to add this, and we're not subtracting because they are like the same. As before, I've been saying that again before, right? Good. So you add it together, you have 31,820 plus 413. So 35,950. I'll take that. So 35,950 still negative. Yeah. Then we move on to the next year. They have 22,530. Wow. So that will give a balance of that will be 13,420. Still negative. 13,420. Then the next, they had 17,000. Wow, it can pay all. Here there's no scrap value. If there's a scrap value, kindly add it to this figure before you discount it. So I'm assuming that how we arrive at the cash flows, you're okay with it. Then we are fine. In fact, this is 13,000. And what they have here is 17. So we just put cash here because they have more money to pay this. So it's dash. So we don't go again. Here, no, that's all. We are done. So we have to go and write the payback period. Let's find somewhere and calculate the payback period. So that one, Ashiza, do it for me. So the payback period will be, let me do it up. So I can have 3 full years plus something months or some years, like half year. Because for the 3rd year, we made money of what? 17,075. But we pick only 13,000 out of it. So we assume that So we assume that this is a full year. So 13 out of it will give us what? Plus 3 full year. That is it. So that will give us all in years. All in years will be, so let me do that one here. So all in years, so the payback, no shortcut, will be 2 full years. Will be 2, it's 3. So 3 full years plus whatever we pick from this. So 13,420 divided by this cash flow 17,075, and you get 3.8 years. I like that too. That's all. So just spare time. You can do years and months, years and days, or all in months, all in days. You are done. These are the possible questions they can ask. We are done with adjusted payback period. That one too, in fact, it is in to solve a major issue for that of the payback. The normal payback, we don't discount the cash flows. Yes, normal payback, we don't discount the cash flows. And it's a major challenge. It means that it does not consider the time value of money. Good. But the adjusted payback period consider the time value of money. That's the good news. So if you want to get the advantages of the adjusted payback period, it's the same as the advantages of the payback period that we know. Just that now add one to it because of the discounting. That example that it discounts the cash flow, which considers the time value of what? Money. So it considers the time value of money by discounting what? The cash flows. You are done. And it incorporates what? Risks. Good. So that will be that answer and the definition. Now you can also have disadvantages of the adjusted payback period. Oh yes, they have challenges. The challenges of the payback period, with the exception of one, also apply. With the exception of the discounting. The main challenge or the issue is that first, have you seen that there is cash flows here? This one was ignored, and the remaining part of this figure was ignored. It's the main challenge. I like that answer. So we had 3.79 years. Okay. Yeah, that's perfect. So here we are saying that these cash flows were ignored in calculation of the payback period. So it also ignores cash flows after the payback period. Yes. And again, it can also let you select what? Unprofitable investment. Yes. So these are the few challenges that we have with the discounted cash flow technique. Again, you can tell the examiner that is what? Complex as compared to the normal payback. Because here you have to now discount the cash flow. Even the issue is the discount factor is how to estimate them. It's not the actual. And it's assumed that the discount factor will remain the same, which is also not true. The discount factor will change. Oh yes, due to inflation, discount factors will not remain the same. But here we have made them the same throughout the year. 10%, 10%, 10%. In reality, they change. So that's the disadvantage that we have with what? That of the discounted payback period. Great. Now we are done with discounted payback period. The acceptance criteria also move in line with the normal payback period. The acceptance criteria will be you accept the project that will pay back, reject the project that will not pay back. So this project must be accepted because it can pay back. Yes. So that is it. Now let's move on to the next one, NPV, net present value. NPV. net present value. So that's the next one on the list. Net present value. NPV, net present value. That is the next one. It also discounts cash flow. It is the widely used or acceptable. We call it income, or we call it the main. Yes. And then homework number 2, explain why NPV is said to be the preferred method. Yes, NPV. Good. No wonder in all your exam questions, NPV is part. All the exam questions your examiner asked so far, NPV is part. Starting from the very first question he asked, NPV, middle one. The next one to NPV. So the next one, NPV. Here he asked for NPV and the internal rate of return. Good. And still ask some theories about NPV. So it tells you that NPV, don't need to deal with NPV. Madam Zavi too still asks NPV. October 2019 to still NPV. Wow. NPV is very good. So it's called net present value. So that's where we are now. Net present value. Almighty NPV. NPV. Now, anywhere you meet something that they call it net, that means they are subtracting something from something. Anywhere you meet something that they say present value, you know it already. Meaning they are multiplying by a discount factor. They are finding the present value of something and they multiply by what? A discount factor. That is it. So net simple means is the cash inflows minus cash outflows. So cash inflows less what? Cash outflows. That's the net. That's the meaning of the net. So all the inflows one side, just one line, one side, all money that you have received from the project. Add. So the inflows can be examples of cash inflows. 1, sales. Number 2, there can be sales receipts. Receipts like receipts, fees. Oh yes, include tuition fee. If target professional consult is considering a new educational program, maybe short and long program courses. Maybe you want to run next year, I want to run short courses and long program. So I want to know whether it will be viable before we enter into, oh yes. So that we consider whether the NPV will be positive or negative, whether the return. So in that case, I will not get sales if I'm looking for the inflows, cash inflows. We are not going to sell anything. We are going to render service. So either we are going to get receipts or fees or subscription. Maybe if you are going to set up a club, you get subscription. So that is it. So take note of that. Now manage all outflows. What are the outflows? They are the running cost. So first, your variable cost. Variable cost, that's the running cost number 1. The examples of outflows, variable cost. Number 2 on the list, your what? Your operational cost, that's the incremental fixed cost. Incremental fixed cost, that's the marketing cost. Good. So these are the outflows. So whatever you are getting for that particular year, minus whatever you are spending on that project, you are done. So that's why we say net. Then that's the first one that I will explain. B, there's a present value. This explains the net. There's a present value. The present value means this answer must be discounted. All the cash flows must be discounted. Find the present value of the cash flows. That's all. That's the meaning of the present value. All cash flows must be discounted. So usually we just pick the net cash flow and discount it. It means that all net cash flows must be discounted. All what? Net cash flows must be discounted. Agreed. You are done. Oh, that side is not coming. Yes. All net cash flows must be discounted. You are done. So let's go into it and look at how it's moved. Then we are done. I'll quickly go through some formats. Yes, we come with some formats. Then we go by the formats. Then we are done because we can see sales here. And then some issues. Then we explain some few technical issues about the NPV. Then pick some nice questions to do, either Abrifa or the Madam Zavi. Abrifa or Madam Zavi. Then we look at that one tonight, if possible. The cash outflow number 2 is marketing. Marketing cost. That's incremental fixed cost. Marketing cost. It can also be distribution. Marketing cost. You can add distribution cost to it. In fact, basically, that is the running cost. Outside the variable cost, the running cost. So, like for a teaching center, running cost will be that of the rental. Yeah, that's the incremental fixed cost. Rental facility. Or you can decide to build your own facility too. That will be maintenance. You have to pay maintenance fee, repairs. Good. The variable cost will be what? Marker, lecturers, examination team, and other costs. Okay, now let's look at the format. There's a presentation for it. Okay, so now let's look at the layout, how we will present the NPV. So in the handout too, I drafted a very nice format there. You have to strictly go by that. Strictly, we have to go by that format. Strictly, we have to go by that. So you start your NPV layout. NPV layout. Now, sometimes we have what you call constant cash flows and different specific cash flow. Good. So we will come across all of them. When you start, get a year, maybe year 0, year 1, year 2, year 3, year 4, in fact, up to the very last year, sometimes year 5. So in fact, I want to be fast, so to the very last year. So if the project will last for 5 years, it will be year 1, year 2, year 3, up to year 5. If the project will last for 5 years, 6 years, you have to do that. You start with your sales revenue. Your sales, record it in so much. You get your cost, your variable cost. Your variable cost. So get your variable cost. So much. This is a format. So it must include everything. But in exams, the examiner might not request for everything. It's what in the question. That's what you're going to use to solve. Okay. Then you got your fixed cost. We call it incremental fixed cost. Incremental fixed cost. I'll explain these terms again. I'll subtract, subtract, subtract. Incremental fixed cost example is the marketing cost, distribution cost. Good. Then you get your profit. Your profit. Profit. Then the next item, quickly, you bring your tax. Your tax, if it's in the question. Please and please again, this is a format, so it includes all of them. Sometimes most of your exam question does not include the tax, so take note of that. So tax, maybe if it's 20%, we charge it on it. And here to wait and get a wording of the tax. Sometimes it will tell you that tax is being paid 1 year in arrears. So we have two ways of tax. A, we have 1 year in arrears. So 1 year in arrears. Then B, we have the same year. Tax is paid in the same year. So the same year. How do you treat that? If you pay tax 1 year in arrears, it means that year one tax will be paid in when? Year two. Please, in NPV or any investment appraisal technique that uses cash flow, the timing is very important. Any investment appraiser technique that uses cash flow, the timing is very important. Wherever you are going to incur it, that's where you have to treat it. So that's why question number 3, example 3 that I give out, still I've not received the solution. Only 2 people that have received it because timing of cash flow was examined there. So take note of that. If I've not done that, please kindly do that too. Other than that, I begin to have issue with you. Okay. Now, if tax paid 1 year in arrears, year one tax will be paid in when? Year two. So we bring it here. Year two tax will be paid in when? Year three. In that order. That means if the project will last for 5 years, create another one again. Maybe year 6 because of the tax. Because the year 5 tax will be paid in year 6. That is it. So that is if tax is paid 1 year in arrears, then you are done. Okay. What if tax is being paid the same year? So if the tax is being paid the B side, that one to look like this. If the tax is paid the same year, then year one tax will be paid in when? Year one. Year two will be paid in when? Year two. And then in that order. So that one you don't need year 5 again. So that is it. Just that in reality, most taxes are paid 1 year in arrears. That is scenario. Good. Then that is it. Then right after this, you go to in fact, I'm putting everything in the format, but not all questions will demand for all. So take notes. Right for me, right here, tax saved on capital allowance. Tax saved. Tax saved on capital allowance. So tax saved on capital allowance. Then right here. Down to I'll do a workings on that. So those ones, let me put asterisk against them. So this very one, number 1, there's a full note on it. Then you go to the next one will be the scrap value. So bring the scrap value here. Scrap value. Usually the last year, put it down, positive. The scrap value will be positive. How much they will sell the asset. Normally, they will tell that they are going to buy PP or they are going to invest. At the end of the year, they can sell that investment for some figure. You put it there. Or sometimes you might confuse and tell you that Oh, we will sell it 1 year after the useful life. So that we have to create additional year for it. It will be sold 1 year after the useful life. If the project will last for 5 years, then they will sell it in what? Year 6. Perfect. Then you move on. Then you go to working capital. Working capital. That one too. In fact, that one will start from year 0. So take note. Everything so far year 0, nothing has come there. Yes, working capital normally we start from year 0. And that one too back with explanation. We have explanation for that. So I'll start from here like this and like that. These ones you don't need to worry yourself. Let me number them. Those guys don't need to worry yourself. 1 and 2. Don't worry. Star value is okay. Tax is okay. So tax is normal. Star value is normal. But the tax saved on capital allowance and working capital, don't worry yourself. Great. Okay, so I think oh sorry, it's clear now. Good. Okay, then you move on to the investment. So cost of investment, that one is a must. Cost of investment. So cost of investment. Down to year 0, you bring it here. Then you are done. So you put all of them together. You are summing from the profit section up to here. So you are summing all of them up. So that is it. So when you sum them up, what do you get? The answer that you get, we call it net cash flow. Net what? Cash flow. So now, the question that you've been solving, where the examiner have given you the cash flow already, the examiner went through this stage to get the cash flow. I mean, so it's not easy. Yes. That's why normally we don't give it for free. So the next line, we sum them up. So here will be here. The cost of investment, that is the investment that you are doing. Put it in brackets. That means here will be negative. You sum all up, you put the answer down. Sum more up, you put the answer down. Sum more up, you put the answer down. Then we call it net cash flow. Net what? Cash flow. Then you move on to the discount factor. As usual, maybe 10%. So you have to discount the cash flows. So if the discount factor is 10%, all what you have to do is to find the cost of capital as usual. Some of them you can memorize them, like 10% for instance, or you can calculate it. So year 0 will be what? 1. Year 1 will be 0.909. Year 2 will be what? 0.826. Year 3 will be 0.751. Year 4 will be 0.683. Year 5 will be 0.621 in that order. That's the discount factor. And now the discount factor that we calculate under the adjusted payback period, we bring them here. Then right after the discount factor, you underline them again. Then, in fact, it's no space here. So let me continue from this side. Right after the discount factor, after you've underlined all of them, what do? Then you write what you call PV, present value. You now multiply all of them, then you double underline it like this for us. Then you are done. This is the format for the NPV layout. Good. Now, there's 3 items that we need to know before we continue the game. All these have been provided nicely in the lecture material. So you can also do that one for reference. You can do that here. Where are you? Good. So basically here. Good. So it has been arranged here. Just that the underlining did not come. So take notes. Then that is it. Now, what are the items that you are allowed to bring on the face? That is the most important section, though. And then that's where I'm going now. Good. We are saying sales, not all sales you can bring. We are saying variable cost, not all variable costs you can bring. We are saying this, not all. So we call something relevant cash flow. Call something relevant cash flow. So for investment appraiser, the most important is relevant cash flow. That means what is relevant to this calculation. So that if I see the irrelevant ones, I don't touch it. I'll pass by. Some are there for trap. Good. So that is it too. So that's where we are going now. And that's the most important thing. I can assure you that whatever NPV question that we set, there must be irrelevant stuff in it. How do you know that this item is irrelevant? That's what we're going to do here. So when you see them exams, you pass by quietly. So I'll start talking about all the items one after the other. And then we use the relevant cash flow to talk about them. So it's very important. And then we'll back it with what? Illustration. So we'll on to claim to. It's going, yes, this one is Christmas harvest. Okay, so we have what you call relevant cash flow, items that you have to bring in your NPV calculation. If you don't understand anything in today's program, not that item, I'm begging you. Okay. So we have what you call relevant cash flow. Relevant what? Cash flow. It runs through all the cash flow techniques, the standard cash flow techniques. So any investment appraiser techniques that uses cash flow, and they've asked you to now estimate the cash flows yourself. You are going to generate the cash flows. Have you seen the first question? You are given the cash flow. In some point, you will be asked to generate the cash flows yourself. Then what are the items do you need to generate the cash flows? That's what we mean by what? Relevant cash flows. Take note. Some of the question, oh yes, they will give you the cash flows already. Some they don't give it to you, you have to generate it yourself. Good. So how do you generate it? So that is it. So let's see. Now all the relevant cash flows, we are going to use their features to select them. Their features to select them. So what are the features? We said the cash flows one, it must be of cash flow. It must be of what? Cash flow. That's all. So before you add something to your NPV, make sure that it's in the form of what? Cash flow. It's as a result of cash flow. Take note. If you add something before you can pick any item, make sure that it's of what? Cash flow. So here, what we don't like, or you have to ignore non-cash item. All non-cash item must be ignored. Non-cash item, all non-cash items must be ignored. Thank you. What are the examples of non-cash item? Almighty. Depreciation. So depreciation should not be part of your cash flows because it's non-cash. We did IAS what? 7, statement of cash flow. So that idea is still here. All non-cash item, I beg, don't touch them. By mistake, if the examiner have added it and if inform you that this item include depreciation, please take it off. Depreciation is not part of the game. That is it. So each and every section and what we use. So over here, we are going to now bring depreciation in. So here, the items must be of cash flow. It must result paying or receiving cash, not just allowances, not just provision. So depreciation and all provisions. Example is what? Bad debt. All those ones, impairment, bad debts should not be part. They're all non-cash items. We're looking for cash. It must result outflow of money. Now let's move on with the game. Okay. Now we are continuing. The next criteria is that item, it must be in the future. Wow. Wow. That's so great. Before you pick this cash flow, make sure that it's in future, it's in tomorrow date. Future means it will be incurred if the program or the project is being undertaken in the future period. Here too, please do not touch past costs. All past costs must be ignored. Past costs. So here, all past costs that you have already incurred them, please ignore. All past or sunk cost must be ignored. So past or sunk cost must be ignored. Wow. Past and sunk cost must be ignored. I like that. What are the critical examples of past costs? In fact, only one pair we use. Number one, feasibility studies must be ignored. Feasibility studies. Feasibility study. Two, research, market research. But before we start this, before we start the project, you have to do some analysis, some research to know whether this project, in fact, how you have arrived at the cash flows. How did you know that this project, year one, you get 40,000 from it, year two, 10,000? You have to do analysis, market research. Sometimes you go extra, go to the field. All these costs must be ignored. Why? Because it has been already incurred. We want the cost that will be incurred in the future. So all past costs must be ignored. So if you see feasibility studies and research costs anywhere, please don't touch it. If they've touched it, take it off immediately. It's not relevant, it's irrelevant. But the issue is that when exam questions, they are setting the questions, we will load it with what? Both relevant and irrelevant stuff. Yes. So take note. Now let's go to the last one, then we are done. I hope I can take it off. It's going over. Going. Okay, so let me take this one off. So each and every one and the one that we used to worry. Let's come here. Then we have it must be incremental or incidental. So the cash flows must be what? Directly or incidental. So incidental or incremental. Incremental. Incidental or incremental. So that is the relevant cash flows that we are talking about. It must be incremental. It must be directly related to the project. Wow. Directly, you. So the cash flow, before you can pick, you have to pick items that are directly. So let me quickly just cite some small example here. Let's assume that you want to undertake some project. They've given you a question. Project A. Now, we are saying that pick cash flows that are directly traceable to that project. So for instance, if I have a sales revenue here, all right, here, with the project is 50,000. Without the project, the company will earn just 30,000. So which one will I use for my NPV? If I'm doing NPV, this one's everybody. So without this interpretation, if the company add the results of the project, the sales of the project to their project, they're getting 50,000. Because we said wait the project, their sales revenue is 50,000. So if they should add, because the money is for you, it's for the company, because it's the company that will invest in that project. So with the project, they are getting 50,000. Great. Without the project, the company can earn 30,000. Which one are you going to use to calculate your NPV? We said we have to pick cash flows that are incidental, that are incremental, that are what directly attributable to the project. Do not add your normal trading items to it. Good. So here it means that if without the project our sales is 30,000, with the project our sales is 50,000. So that means the project brought what? Brought 20,000. So in my NPV calculation, the project brought 20, so I have to use the 20,000. That is what the project brought on the table. And that is the cash flow, which is what? Directly or incidental to the project. If you pick the 50,000, that means you are valuing your company and the project. But the question is, you're only valuing the project, not the company together. So pick cash flows that are directly coming from the project. That is all. Great. I'm done. Over here, what do we use to disturb? Like each and every section, what we use to disturb. Here we depreciation, here we research and feasibility and cost. Here to use what you call general fixed cost must be ignored. General what? Fixed cost must be ignored. Don't touch general fixed cost, it must be ignored. However, the fixed cost that we want, it must be incremental fixed cost. So general fixed cost must be ignored, but the fixed cost that we want, it must be what? Incremental fixed cost. So they must call it incremental fixed cost. I'm done. Incremental fixed cost. That's what we want. So if you like, if you check on the face of the format that we wrote just now, realize that the fixed cost that I placed there, I call it what? Incremental fixed cost. I do not call it just fixed cost. It must be incremental, incidental to the project. Good. So that is it. General fixed cost must be ignored. We are done. So let's go and look at Abrifa and then we'll be fine. So I will scan through Abrifa and see if we can do justice to that one. But before that, if you do have any questions, suggest we can bring it on board. It means that in one particular question, definitely there will be depreciation, there will be research, there will be general expenses or incremental fixed cost for you to see whether you are going to touch them or not. So kindly take notes. So let's go to Abrifa Limited. Abrifa. Abrifa, we can look at it from here, or we can also look at it from the other end. Let's look at it from here. I think this one is a bit clear. Abrifa is question number. Abrifa, where are you? Abrifa, won't you respond? Good. Abrifa is here. October 2017, question 2. That's Abrifa Limited. So let's look at Abrifa Limited. And this was a repeated question in that of the October 2019. Yeah. So October 2017 to October 2019. So that means So that means October 2018, right? Okay, that's fine. That's your paper. Now let's go straight to the requirement before I deviate. As a newly engaged management accountant, you are required to report to the board of Success Limited, Success, wow, indicating whether or not the project is what we are using NPV. Using NPV. So for NPV, we have the acceptance criteria as usual. For a single project and then double project, all of them has been splitted in the manual. For single project, you accept the project if the NPV is what positive. Reject the project if the NPV is what negative. We are done. Great. Then using NPV and internal rate of return method of appraisal, IRR, internal rate. That means after the NPV, what's left for us to do is the internal rate of return, and then that is the end of the game. Then say list 3 strengths and 3 weaknesses of NPV, importance and then disadvantage of NPV. All of them are in the material, well discussed, and we'll still discuss them if we do have little time. We will discuss them. Great. But all the same, all of them has been included in the other lecture material. Yes, it has been stated clearly. Okay. Okay, so that is it. Now let's go to the main show. Abrifa has just set up Success Limited. Wow. Which he is seeking profitable ventures to invest the capital Abrifa had accumulated during his several years of his work as a public servant through savings. The company has engaged you as a management accountant. Information gathered through a survey indicates that if the company introduces its new line, YOI, the following is likely to result. So the items are there. 1. Sales of 15,000 units could be achieved if the price were set at 200. So that means they can sell 15,000 units if the price is what? 200 Ghana cedis per unit. So that means the sales revenue will be 15,000 units by the 200. That will give her the total sales revenue for each year. For each year, variable cost will be 175 Ghana cedis per unit. So that also means the variable cost will be 175 by what? By the 15,000 units. So by the 15,000 units here, and then that will give us the variable cost. Now let's continue. Fixed cost would amount to 75,000 per annum. Fixed cost will amount to 75,000 per annum. With this one, let's read further whether they have added any other item to it. We take it off. The life of the project is expected to be 5 years. Great. Note 5. The cost of capital is 10% as usual. If not 10, 15 or 20. Yes, these ones are very easy ones. 10, 15, 20. But be careful what they're giving you. Yes. So just pick what they've given you. Find the discount factors. You are done. Note 6. An additional 300,000 will have to be spent on development costs before production can commence. The amount of development costs includes 200,000 representing the time spent on research and development personnel. If these personnel were not working on this project, they would devote their time to pure research. So, as usual, research should not be part of it. It's irrelevant cost. Why? It's a past cost. So this 300,000 now take the entire 200,000 off. However, development cost should be part. Development cost should be part. Research cost is not part. So that development cost, not all of them are for development. 200 is for research, which we said is not part. So you take it off from the 300, leave it what? 100. and then it will be part of. You look at where they are going to incur it, exactly the day that they will incur, they will pay this money, you put it there. So it means that this money will be incurred when? Before production commence. So before production means year zero. If you don't put any year, it means year zero now. So that means you have to add it to the cost of investment. Perfect. Now let's continue the game. Note 7, special plant will have to be purchased for 100,000 immediately. This should be depreciated at a rate of 25%. The depreciation of the special plant is included in the fixed cost. Wow, in the fixed cost. So that means we know that the depreciation is non-cash item and therefore it is what? Irrelevant cash flow to us, irrelevant item or irrelevant cost. So it should not be part. So let's calculate the depreciation per year. Then you take it off from that of the fixed cost. They say they depreciate it to what? 25%. It should be depreciated at the rate of 25%. If they don't tell you, use a straight line method and you'll be free. So let's use a straight line method of depreciation. So that would be rate by what? The cost. So 100,000 times 25. So that will give us 25,000 agreed. So 25% times the 100,000. There's no scrap value here. So you come and take it off from this 75. So the actual fixed cost will be that of the 50,000, not 75 that you see there. So I'm done. So that is the end of the game. So let's go to the board and quickly provide solution to this. I will not refer again. So I believe strongly that you have the hard copy of this material or you have it on your other device. So that we move on. Now this item, the cash flows are constant. If the cash flows are constant, you do just one working somewhere, then you are done. So just one workings. So first of all, we have to determine the cash flow. So first, determination of the cash flow. So first, let's determine the cash flow. If you read and the cash flows are the same, like this particular question, some questions they are not the same. Let me project another one again. If you go to question like this, you see Danco, the revenue is here, 1,250, cost is here. It's different from year 2. These ones are not constant cash flow. This one, the cash flows are different each year and its own cash flow. Good. Have you seen here too? Danco has undertaken market research at a cost of 200,000. Oh yeah, ignored. Don't touch it. That's all. Okay. So let's go back to our question. So in our question, they didn't tell us that 15,000 for year 1, 20,000 for year 2. Those year 1, year 2 issues are not in here. So it means that it will be the same throughout for all the years. So there's no need for you to show this consistently for all the years. Just do one workings and use it to represent all the years. And that's what we are going to do. So kindly take note of that. Let's look at that. We barely have 12 minutes to finish, and we are going to use 12 minutes to finish this. So first, cash flow. So we're going to estimate the cash flow. Maybe question A. We are going to estimate the cash flow. Okay, we are going to estimate the cash flow. Wow. We are going to estimate the cash flow. So it starts. You put your Ghana cedi maybe in 3 zeros. If the figures are getting too much or huge, you raise them 3 zeros. But if they are too low, just maintain them to avoid trouble. Okay, so first I'll start my sales. They said that they are going to sell 15,000 units. And then the selling price will be what? 200 Ghana cedis. So that will give us So this one give her 3 million. Yes, but we have raised 3 zeros here. So we have to write what? Only 3,000 agreed, not the 3 million. Perfect. Because we've raised 3 zeros. Good. If the figures are too huge, raise 3 zeros and then we are fine. Now let's continue the game. There's variable cost, right? Let's go to the variable cost. Good. So let's go to variable costs. Variable costs. Now we're told that still 15,000 units by Ghana city of what? 175. And that'll give us, don't forget to rate 3 zeros. So you can cancel these 3 zeros when you're doing your workings. They are the one that you've raised them there. So that'll give us 2625. 2625. Okay. Put it in bracket. That suggests that we are subtracting something from it. We are subtracting from the sales revenue. Let's go to the incremental fixed cost. Incremental fixed cost. The fixed cost here, I open my bracket, is 75 minus the depreciation. Let's go and calculate the depreciation. Depreciation will be, they say the rate is 25%. So it will be 100,000 times 25%, and that will give us 25,000. We've raised 3 zeros, so minus 25. Take note. So the incremental fixed cost must be 50, not the 75 that they are saying. Why are we subtracting the depreciation? We don't want to see depreciation, but they have wrongly added it, so we are reversing it. Take note. If they've not touched depreciation at all, don't touch it. Like this particular question, the very last question in the handout. And look at that question carefully. The very last question. Look at this. Here, depreciation is not in there. They've not added it anywhere. So, but they've given you the methods. How they should calculate depreciation. So take note. For this particular question, is your own in advance. Everything about this question. Yes. You are calculating payback period and then the NPV. Oh yes, it's for you. Then when you are done, you do the II also for me. Explain two advantages of discounted cash flow method. Two advantages. I wrote 3 advantages before we start this particular section. So you can go back and review what we said about it there. Then you are done. Okay, let's continue the game, eh? Let's go to the board. Why are you? Why are you? So 50. That's all. Do another item again. The development expenditure, it will be incurred in year 0. So take note. The development cost will be incurred in when? Year 0. So let's get a profit. So this is the net cash flow. We'll call it net cash flow. We will not call it profit. The net cash flow. And that will be net cash flow will be, so 3,000 minus this. This 325, right? That will be 325. Agreed. 325. Agreed. So it means that the cash flow will be 325 each year. So when happening that way, we don't need to report 325 each year. We've been able to estimate the cash flow for each year. Then we go to the calculation. Then we will now go and prepare. In fact, you're supposed to do something like this. Year 1, year 2, year 3, year 4, year 5. Time is not there for you to do all this repeatedly for 5 years. No, don't do that. Because they are constant. Repeatedly. No. So that is it. So let's go and calculate the NPV here. So now you're now going to calculate what? The NPV. This one is just working. So NPV. First, you write the year here. So start from year 0, 1, 2, 3, and then 4. Let's say 5, and so 5 years up to year 5. Let's go down small. Tell the examiner that this is the cash flow. This is the discount factor. In fact, to avoid confusion, write the percentage down so that you remember which one you are using. Then finally, the present value. Don't forget that you are working in thousand and bring it to your currency in thousand. Year 0, let's go and then estimate year 0 cash flow. Year 0 means now, today, what you must invest before you can earn that money. So what you must invest, that's the year 0. If you go to this question, what is the investment? The investment value happen to be how much the initial investment. So they say special plant will have to be purchased. That is investment. Immediately means year 0. And the cost is 100,000. So it's year 0. Good. Plus any working capital or development cost. Here they have a development cost of what? 100,000. Why 100,000? They've spent 300,000 or they need to spend 300,000, but out of it, 200 is a research. And we said research, we don't like it. So you have to only pick the development cost of 100. So it will be 100 here plus 100 here, making 200. So let's show workings, how we got the 200. So workings, this one is workings number 1. I'll do that one here. So I'll tell the examiner that year 0 cash flow. So you tell the examiner that workings. Workings, where should I do? Where should I do? Okay, let me do that one here. And I'm going to find it. So this one is working. Do it somewhere. Year 0 cash flow. I'll start with the special plant. So special plant. I'll read 3 zeros on top. It's 100. Tell the examiner that development cost will also be incurred in year 0. That will be what? It was 300 minus the 200. That one is also 100. Putting all this together, the year 0 cash flow will be what? 200. Why 200? This is the computation. You are investing 100 plus the development cost of 100. That is it, making 200. So year 0, immediately you put the 200 here, put it in brackets. You are done. Okay. Now let's finish the game. We are done. Please can I take the workings off? So you can do that and then. Okay, so let me take it off. We've shown working how you got all the figures. Now the cash will be the same constant 325, 325, 325, 325, 325 throughout. Then what do you do next? Discount factor 10%. Oh yeah, let's go. Discount factor 10%. Year 1, what will be the answer? Year 0 will be 1, right? Always put a 1 there. Year 1 will be. So the discount factor that we learn how to calculate them, how to arrive at them, they're the one that we need here. So we can start like this. Year 1 is 0.909. Year 2 is 0.826. 0.751. 0.683. Finally 0.621. Perfect. You're done. That is the discount factors. Yes. Now let's get the present value correct. 200 times 1 will give us 200 negative. This times this will give us 325 times 0.909. That will probably give us okay, so 295.43. So 295.43. That'll be the very first one. 268.45. 268.45. The next one is 244.08. So 244.08. Then the fourth and then the fifth one too will be 221.98. So 221.98, right? Yes, that's .98. Wow. Good. So it's 2.98. Last one is .98. This one is 09. .98. The last one is 201.83. 201.83. 1.83. Putting all this together, we have 1,000, 31.77. NPV is positive. What will be the interpretation? Once the NPV is positive, they should accept the project. Accept project with positive NPV. If it's single, accept the project. If it's multiple projects, like 2 or 3 or more, accept the project. And you have to accept just one. Accept the project with what? Highest positive NPV. Good. And that's all. Great. So that's the end of today's section. Thank you very much. Writing the figures, you have to write it in full. So in writing it in full will be Ghana city of 1,031,770. That's the NPV. It's positive. But I don't want trouble like myself quoting figures. No. I just tell the examiner that they should accept the project because the NPV is what? Positive. I'm done. I will not quote any figure. Yes. If it's negative, they should reject the project because NPV is what? Negative. Good. There's a second question here. Is ESL part of the ES? Yes, please. ESL is part. ESL means now. That is where we are going to put our investment in, the cost of investment or the cost of the initial investment. That's where you have to put it in unless otherwise stated. Unless otherwise stated. Good. So basically that is it. Please, the other question that you have to try them. The other questions that you have to try them. Some of them have solution. Let's go to examinable question with their suggested solution. So all of them are in the handout. So we have what you call solved questions. And you say kindly check the end of question 3 for the solution. So that one is here, new ventures, and this is April 2019 question. New Ventures Limited is considering investment in one of two projects. Yansa Bank Limited has been approached to provide a bank facility to support the projects. The bank is willing to only one of the projects. That's mutually exclusive projects. Mutually exclusive projects. That means we cannot undertake the project, the two of them together. No, cannot happen. So if you look at the question here, assess the two projects using the payback period and net present value. That's all. B, based on your result, comment on two advantages of each in respect of the two methods. So pick NPV, two advantages. Pick payback period, two advantages. You are done. And then the advantages of NPV are many. There are lots. Time might not permit us to discuss. All of them are stipulated in the book. I'll scan through them for you. Now, look at the C. With reference to the above project, state the acceptance criteria for the two approaches. Acceptance criteria. So, payback. On what basis do you accept the project? Okay, tell the examiner that I will only accept the project if it can pay back. You are done. NPV. If it's a single project, accept the project with positive NPV. That's all. And then if there are two or more projects, then they say with reference to the above. So if there are two or more projects, what do? You accept the project with the highest positive MPV. Highest positive MPV. That's all. Then you are done. Please, you are trying all questions, especially those that has been solved, the solved ones. You are trying all of them. This particular one, the solution is in there nicely. Good. Let me explain this particular one. What level is the internal rate of return? That's what we've not done. So, like on next meeting, we will try. If tomorrow we can meet between 6 to 7 to do just the internal rate of return to finish everything, so that on Friday we can look at the business valuation. I'll be so happy. Now, all of them, their acceptance criteria have been provided in the book. So take note of that. I think there's one that I did here. MPV, I did MPV here. So right after the format, you descend down to explain some few points. The relevant cash flows has been explained here, giving examples in there, which must be ignored. Decision rule, that's the acceptance criteria. For a single project, accept project with what? Positive MPV. But for multiple projects, accept project with what? The highest positive MPV. You are done. These are the advantages that we have with MPV. We have a lot of advantages. So kindly go through them and then you'll be fine. Then the negative or the bad issue, that's the disadvantages of the MPV. All of them are also here. So yes, then that is it. So kindly try all these questions and then you'll be fine. This is well solved question here. That's target publications. All of them are here. So I can see research and feasibility studies conducted by the team of professionals at the cost of 100,000. Ignored. And then that's all. Good. So basically we are done. Let me go back to the question, the soft questions. Internal rate of return, that's what left. Yes, I have to throw more light on this. Internal rate of return, that's what left for us to do to finish everything. So it has been provided in here. Then I think I will talk more about the profitability index. Yes, I think I'll talk more about the profitability index. So, and the steps has been provided for that of the internal rate of return. Okay, good. There's a question here. Please, the year zero will not make it 6 years. It will still 5 years. It's still 5 years. Good. Year zero means now, so it's not part of the discounted years. Now. So that's why the discount factor for year zero is always 1. For 1 Ghana cedi today is the same as 1 cedi. So that is it. I'll explain certain things. Let's continue the game. So right from the that of the internal rate of return, this we have provided steps here. So like you can follow the steps and follow one of the examples. So steps in calculate of the internal rate of return. You can follow the steps here for me nicely. Then you'll be fine. Kindly take note of that. Kindly take note of that. You can follow the steps here. Follow the steps and then follow finally the formula. So decision rule is also there. So example is here. So example have been done nicely. Right from there, please all these questions, solve them. This particular question, I need the answer to it. And there's one, project T and project R. Yes, question 2. Plus question 3, agape. Yes, agape. So look at agape 2. That is it. When they're done, then the solution continues. Then right after the solution, we have what's the name? Tutorial question. That one, no solution. Yes, this one, no solution. I just go question 1, but the source has been provided. And then Kwame. Kwame is your own, is internal rate of return. You will try it. Then Abrifa is what we've done today. Then, yes, I think we are done. Please kindly try this one for me. I need an answer by the close of, let's say, before tomorrow's class. Answer to this particular question. Question 7. Please, I need an answer to this. We need an answer to this particular question. All of them. And then I'll be very grateful if you can do that for me. Okay, so on that note, we will end here and call it a successful meeting. Thank you very much for coming. Then have a nice evening. Kindly subscribe if I have not done that to the page.